So let's turn to mergers and acquisitions and activism. As we were exiting 2024, there were just huge expectations for the volume of deals that would happen in one form or another. January seems to be a lot slower than those expectations would have suggested. January doesn't make a year, January doesn't make a trend, but Travis, let me now ask you to wear your co-chair hat from Baker Botts and talk about mergers and acquisitions. What's the landscape look like? What's the trend line in terms of, do we get to those expectations before, and what are some of the major things shifting how this will play out in real time, or the real world rather?
So in my view, I think M&A over the next couple of years is kind of an overdue imperative for a lot of companies, for a variety of reasons. The main one is just pent-up demand, both for people that are looking to acquire in order to get the benefits of inorganic growth, for those that are trying to handle some of the uncertainty and the changes, the reshoring, onshoring, friendshoring, and then also on the supply side of companies that are going to be doing carve-outs, divestitures, moving out of certain jurisdictions where they know that may not be the best source of growth for them. And on the sponsor side, really focusing on capital recycling and sponsor monetizations, as a lot of those are due to a variety of headwinds against divestitures throughout the last administration. And so on a more global scale, there's going to be shifting in terms of things in different jurisdictions moving into different people's hands based on where they want to focus their supply chain or their operations. And on the U.S. side of the equation, just kind of narrowing down that focus, again, getting back to the regulatory aspect, yes, it will be a more permissive environment than it was. We don't have yet the benefits of a truly reduced interest rate environment that would really provide some of the leverage for the financial sponsors to get out there and be as aggressive as they'd like to. But capital inflows continue to increase. And I think that because of the expectations that people have of the Trump administration being more friendly to getting deals done, people are going to be more aggressive, or at least more willing to transact than they may have over the past few years. So we're just going to see, as a result of that, more deal activity.
Hey, Travis, you kind of broke in and out there, froze. I don't know if that was on everybody's or just on my screen.
Okay.
But could you give us a summary of those things? Because it was hard to follow.
Sorry. Can you hear me better now?
Or is there something to do to check? Yeah.
Okay. So the gist just being there's sufficient demand at this point of pent-up demand in deals, whether that's on the divestiture side or in the acquisition side to put capital to work. And there's a sufficient expectation now from parties on both sides of the equation that we will actually get to see more deal flow, in part because this is a government that will be more permissive than the prior administration, even though it's not like the Trump administration was the most permissive that we've ever had. I mean, again, looking back at the first Trump administration, they actually were pretty aggressive in antitrust enforcement, in CFIUS enforcement, and in other kind of regulatory restrictions on M&A during the first term when compared to the Obama administration.
Great, thanks for that. Hey, Vivek, let's flip it a little bit. still within the framework of M&A, but activists are really stirring up that pot too. We've seen that the last couple of years. It feels like one of the best defenses of an activist thing is to spin off some part of your company. But we've got a couple of slides that Maya will hopefully put up. But why don't you talk a little bit about what looks like today's activist playbook?
Yeah.
And then talk about what does that look like for a company before, during, and after, so we can think about the long-term ramifications.
Yeah, no, sure thing there is. No, I do feel and that management teams and boards are much better prepared to see an activist than they ever were. They understand what their demand might be in various categories. They understand what they should do about it. They understand what it takes to get them to go away. So it isn't what it was maybe in the 80s and 90s, where you were really worried, it's barbarian at the gate sort of thing. It's just different. And Travis hit this. If you look at what you said and look at the data behind it, since 2010, what are the areas in which activism has been a focus, has been a focus of activists when they come to companies? And it starts with corporate governance and management, because that's a big bucket and it's one that they can do something about. What are they? They generally come in with the intent of being able to change something material, see an outcome, and then exit, right? So if they don't have any one of those three things in place, then it's not so profitable for them to spend their time on a particular company. So there has to be an easy path in terms of an improvement, right? And that typically is in getting the governance right. There may be pockets of M&A that might be interesting, and this is what I described when I talked about Stargate and the energy emergency, right? There'll be three areas. It's going to be around what happens with the supply chain farther down. It's going to be about portfolios and what can I do about it. It's going to be about strategic actions. And then we are increasingly getting comfortable with a higher for longer type of interest rate environment, which has implications for capital structures. It has implications for operational improvements in order to make up for those capital structures that will stay in place. So cost and capital management will be important. And I think if you take that and say, how do you prepare for it as a board? Who's likely to target you? And each one has a particular playbook, so to speak, as Claudia has described. And there will be a path for it. And then maybe hit the next slide as well, and I'll hit it quickly because it's got some data that is interesting, I think. This data says what happens pre-activist and post-activist. And it talks to what I said, they have to have an action that they take and get an outcome. And usually they're worried about that outcome in a 3 to 5 year window. And if you look at that, the actions that they take mirror the outcome that you get in that window, right? So you come in, you see in that purple line, once the action is taken, it outperforms the rest of the market. But then it isn't durable beyond the 5 year window. And typically activists don't worry about that. On the other hand, if you're a company, this is not so bad for you, because rather than comparing the 5 year to the market, if you compare the gap at the 5 year to the market to the gap at the 5 year before the activism, you're better off. So, in every which way, it isn't something to be feared, and it's something to be prepared for, is my sense.
Great, thanks for that. Hey, Claudia, let me flip it to you. In at least my days on BLC, at least somewhere in that 10-year window, we used to use the term act like an activist from a board perspective. Right. And one of the comments said something very similar to that, act like an investor. Easier said than done, right? Because the activist has a team of folks that are doing all sorts of data analysis for them. Arguably, the board does too, but it's via the management team. And not all times are the management team really aware of how the outside market forces are kind of thinking about them. So from a governance perspective, putting aside, small bolt-on acquisitions, but strategic acquisitions, decisions to split up a company, decisions to sell off parts of your company, that's where strategy really comes into the mix. So with all these competing forces, how do you think about that, and what advice do you give boards?
Well, I mean, I think you're not just relying upon management, right? I think, some healthy exercises are having, your investment bank or another investment bank help you look at your company the way an activist would, help detect, uncover any potential weaknesses, and then for you to act upon them to the extent you can in advance. There are usually signs also that an activist may be interested in your stock. Those are things you should be monitoring. I mean, you should have a stock watch. And, you may want to do a survey of investor sentiment. I mean, investors, when they speak to IR, do not always tell you everything they think. So, an investor sentiment survey can be, an early warning system. I think, when you're thinking like an activist, one of the things everybody should be doing now, and I think a lot of companies are, they're looking at their board composition. What are the skill sets on the board? Do they match the skills necessary to oversee execution against the long-term strategy? So some skills may no longer match up. Activists love going after long-tenured directors. So, when you look at your board, you have to recognize these realities, and, you may do some rejiggering. Last year we saw a record number of CEOs shown the door, as a result of operational activism. So, I think it's worth, considering, whether the CEO is vulnerable, and whether the activist is trying to sort of drive a wedge between the board, the CEO. I think you also want to be doing things like looking at comparative performance. It's not just your performance, it's your performance comparative to your industry peers, 1 year, 3 years, 5 years. Another interesting issue is settling with activists. I think last year we saw a lot of companies settle very quickly. And, presumably in an effort not to have a protracted battle. But there's a little bit of a danger there too soon, with settling too soon, because you can have other investors with a similar thesis who then pile in. So, you've settled once and you still have the same problem. And, I would just say, in terms of M&A, I think it's worth, thinking about some of the basics that should be in place at a company. Whether you're going to be an acquirer or dispositions, you want to make sure you have a team in place. I mean, the idea, I think, is to have a reliable, repeatable process. So there should be a robust diligence process in place. And the M&A process should cover post-closing integration, where so many deals fall apart. And then I think part of the discipline is post-acquisition review. What went well? Did the deal fail? Why? So we don't do it again. And then lastly, I would say, boards need that attitude of constructive skepticism. So when a deal comes to the board, important to recognize sometimes management falls in love with a deal. They think it's great. And the role of the board is to constructively ask questions to make sure the assumptions, et cetera, make sense.
Yeah, that last point you mentioned, Claudia, I remember I had a client there. It was a $200 billion transaction when $200 billion was an important, a big size transaction. And the management team had been working on it essentially full time for 2 or 3 years. It was a company that was on their horizon for 20 years, right? Because they play in a small pool. Everybody knows who it is, and it's all about what product they thought was going to come out of the curve higher than the marketplace. And they went after it hard. It had international jurisdiction issues, right? It was a UK domiciled organization. And they were hot to trot, going back and forth, and stuff was showing up in the papers despite all the confidentiality agreements. And then all of a sudden one day it stopped. And the reason it stopped was the management team, at the behest of the board 2 years earlier, said, what's the cap that you would be willing to pay so that emotional adrenaline in the heat of battle trying to close the deal doesn't make you to take what could be a fantastic transaction to a horrible transaction because you wound up in the heat of the moment overpaid. How do people put in some of those guardrails to make sure you don't, in the heat of the moment, give away the company?
Well, I think the numbers have to work. I mean, I think that's pretty basic. And, you have to make sure your base case is really a base case, and understand the potential downside. And I think, that's the reason you may go out and get more than one opinion on the fairness of the transaction. I mean, there can be many others, but, everything with a grain of salt. And I think, having the discipline about how much you want to pay, that kind of discipline is terrific, but also digging into the numbers to make sure they don't make sense. I mean, I think we've all seen too many hockey stick type, visions of the future.